So weird. My computer defaulted to using, I think Microsoft Edge is what it's called.
Oh, geez. I'm like, who actually uses that? I mean, like,
Not me,
it's
but it
probably like
always it
that's
just
probably
logs
the
me
only way to
into the
get
wrong
people.
account now. Yeah. Now I'm logged in as like my old personal account I had when I was a kid. So anyway, we are live. So Justin, welcome back. We're not going to talk about Microsoft Edge. We're going to chat about that video. Michael Zuber actually sent me that. Wondering a lot of the time. He sent me the video and very interesting that that would get posted, that he would post
Mhm.
$100 million issue of investor capital that could just go poof. And you think about that, if his portfolio is $1 billion, 10% of the value is going to disappear like that. And that's 33% of the equity
Mhm.
before sales fees. So if you figure sales fees and transfer and everything, you're looking at like half the equity on that deal before tax is just going to go poof.
Exactly. Yeah. And I think there's a couple big takeaways on that video is that the problem is much bigger than the initial post. The initial post was one property, and I believe he lost 15 million. Now, we're specifically talking about Brandon Turner, but this is systemic across the entire industry. And I gotta think that there's a lot of operators that are not as savvy as Brandon. So there's probably a lot more out there that are in much worse position. But let's just focus on Brandon specifically for this one. When he came out with that original post, because I know that he did like I don't even know how many he did over a couple year span. So if that's the first one, that's kind of the tip of the iceberg. There's much more there. And this video, which came out, I just watched right before the call, alluded to. It sounded like there was literally just one property, incremental, not the 15 million, but another large one that had a potential where it's going to lose $50 million on it, right? So he's got a lot more properties or bigger issues out there. So that was like the big takeaway there. And then ultimately the question comes down is, do you fold and just, you know, implode, or do you go the way of the buffalo, run into the storm? And that's kind of what he was talking about. He's like, well, if I can build $100 million business and sell that business and get half of that, i.e. 50 million, to
Mhm.
pay off the 50 million hole, then he's able to save the day. And he had mentioned a timeline of 3 years, which I was kind of surprised that there's 3 years. So maybe he refinanced 2 years ago, and in 3 years the refinance comes up and it's going to be an issue. So the question is he going to do it or not? It sounds like he's trying to find the next big thing to generate enough money to fill the hole.
Pretty wild. Just as a percentage, it sounds like basically every deal he did was a dud.
In today's numbers, 100%, yes.
And the,
And
the worst part is I experienced this firsthand when I sold a property that I did a bunch of I took depreciation, I took losses on. If you don't sell it for like a massive gain in 1031, it's so painful to sell
mhm,
if you sell in the near term. So
yes.
I mean I have to imagine that they did cost segs. So if they're selling at these losses, I mean imagine how much that would suck if you lose your capital and have a or lose some of your capital and still have a taxable event like on paper because of the debt that they had and the depreciation that they took. That I'm not saying that's the case at all because I haven't seen the exact numbers, but personally, where I've levered deals up and then uh, took write-offs against them, when I sell something, I may not get a huge cash injection, but I could have a big tax event that could really make that return on it back end. Have you seen that yourself?
Say that when you say cash injection, say
Well,
that
so
again.
so like when I sell a property, right, I get a cash
Yep.
injection because that cash goes into my pocket if I don't
Yep.
1031. And having levered stuff up, I don't know if he's done cash out refinances on any of these, but I did a cash out refi. I didn't get a whole bunch of cash and I had a big tax obligation and it expressed as a percentage of the cash I was getting. Taxes really negated the purpose of selling.
No,
It's pretty
yeah,
brutal.
there's been times like so early in the career, I was in basically, the zero interest rate environment. So I was very lucky where, the stuff I bought effectively went up like 50% in a couple of years. So people are always like, well, how did you grow so fast? Both your side, my side, back in like, 2020 to 2022, like I did probably close to 50 cash out refis, like two sets of mega cash out refis. And so then I was getting hundreds of thousands of dollars and then going pumping it into more properties. Now, when you're doing that, you avoid the tax scenario if you do the 1031. Most recently on some stuff that I did, it was very little, money to come out. Or when I go to sell them, if you run into this scenarios like, is it worth even selling it? Or should I just hold it and take a small loss and see if it, improves in the future? Or do I sell it today? Yes, I get a little bit of cash today, but then where I originally bought that property, that's where the taxable amount. So it's very the longer in the game, the more you're thinking about not just the face value. What do you get at the close? It comes into now you got to look at the tax scenario, especially being in Washington because we have capital gains tax, national, the regular one, and then we have a state capital gains tax. So I think it's like 7% on top of the national one, and if you're above like 200,000. So we're looking at what would we actually get in our pocket when it's all said and done. And I think the main thing is like just kind of keep rolling it forward. How
Well,
do
on the
you go ahead?
yeah, but on the Brandon Turner thing, like I don't know how the taxes work if you lose the property. Do you know? Like is a recapture tax, like is that a thing if you lose it?
Yeah, that's what I'm trying to understand. Well, you would still have to, so you would have to recapture it. Let's just go like an extreme scenario. Let's say it's worth 100 million, right? And let's say the depreciation is 100 million as well, right? So if they were to take all that 100 million appreciation day one, yeah, I know this is not real, but
Oh,
let's
sure.
just
It is a
assume that, right?
hypothetical. Okay.
Hypothetical. If you took all that depreciation day one, and then everybody gets, say there's 100 investors and everybody gets $1 million to offset their existing income, right? Everybody loves that, right? Then they go to sell it. Let's say they bought it at 100 and they sold it for 50 million. On paper, they lost money, but on a taxable 50 versus zero, I think they would have to do the recapture on the 50 million, is how
Yeah,
I'm
if their
taking.
base well, if their basis was zero in that scenario, then
Exactly. Yeah. And I know for a fact when, back in 2020 to 2022, because I was still at the W-2 job, there'd be tons, everybody loves high income, sophisticated investors because they're prime for the syndications. They're going around saying, hey, here's all this money that you guys can make from doing a cost segregation, right? And so there's a lot of people that were really excited about this cost seg thing, which to me that's like second order of the project, right? It's kind of
mhm.
like the gravy on top of the meat and potatoes, right? You should only get into a syndication for the meat and potatoes, meaning it actually generates cash flow and there's upside to it. Now, can you do the cost seg? Yes. Okay, awesome. Now that's like the gravy on top. It's kind of like, some people do, I think it's oil drilling or something like that. It like loses a ton of money, but you can effectively write off every dollar when you do these oil rig things, I believe. So for some people, it probably makes sense, but the average Joe person, we shouldn't be doing it just for the cost seg. It should be like put money that's going to generate more money. If you get the tax benefit, then that's another plus side to it.
So it could be worse, basically, what you're saying, than even what we hear of, oh, you could lose $100 million of investor capital. It could be worse if there's a tax implication based on their basis in the deal, because your basis goes down over time. It's my understanding. You do
Yes.
write-offs and then that gets written down. So you have a bigger gain if you sell it because you took the
Yes.
write-offs up front. So basically borrowing benefit out of the future when you do your advanced write-offs.
Yeah. It's a
So
reason why they call it, another way to say it is called accelerated. You're moving it forward, depreciation, right? So, I
what
mean,
other
it
notes
just
did you
goes to,
take from that video? The Brandon Turner video. I know everybody's talking about it right now, so we're beating a dead horse right now. What were your takeaways from that video? Because you mentioned you did have some notes.
yeah, I took a ton of notes over here. I'm looking at my notes off to the side of the screen. So, some of the big ones here that no matter if you're doing a syndication, you're a house hack, whatever, you have a business, say you own a laundromat. The one key takeaway at the very beginning kind of slipped in there was revenue does not equal profits. And he said in there, he goes, let's just say his fund is $1 billion. He goes, the guy that owns a duplex made more money than I did because even though he had $1 billion, if he's negative cash flow on the $1 billion, the guy that has one duplex, the lady that has one single family rental in Kansas City or whatever, they're making more money profit, even though his revenue number is, I think he said it was 165 million related to the portfolio, but he's still negative cash flow.
See, that's just stupid though. I mean, if you figure he took 1%
Mhm,
fee, put those deals together, and he bought it 1 billion.
mhm.
He may have paid less, but it sounds like he's not exactly profitable on these deals. So he would have gotten $10 million
Yeah,
to put these deals together. There's
right.
nobody with a duplex or a house that made more than that.
Well, he's talking about ongoing cash flow. He it wasn't
But that's his
referenced,
fault.
but
I
yeah,
mean, so the same person could go out and buy a single family house and be negative as well.
yeah,
And
100%. Exactly.
it
Which,
comes down to the operator. Like you're right. The revenue does not equate profit, but that's completely his fault, to be fair.
yeah. And I think that what I appreciate about this is that it's just a basic fundamental that every time there's a runaway valuations, the fundamentals always win. And the fundamentals are literally, do you have a sustainable business that generates income, has expenses, and there's an actual profit and we can return income to the shareholders, right? Now we're talking about syndications. If you translate that to the stock market, the fundamentals have been out the window literally since 2020. The majority of these businesses, there's a ton of what they call zombie corporations. The business doesn't even cover what the debts are. They're just kind of restructuring debt to kind of stay alive. So at some point in time, I think Brandon Turner is the canary in the coal mine for syndicators, right? We all knew this was going to come up because that there's only these they're only 5-year commercial debt, majority of them. So interest rates went up and call it, I think, 2022 for sure. So between 2022 and 2027, if you had locked 2027, even for myself, I have a 16 unit that we are in process of refinancing. These 5-year window, everybody has to come to the table and their interest rate's going to go 50 to 100% higher depending on where they got in at. Like we're at 375, we're probably going to go 6.5, right? So we're going to go 50% higher. Now, thankfully for us, our valuation's up there and our cash flow has increased. So I think we can do a just straight refi and be fine. But when they had so many big ones, I think their biggest issue is that they don't have enough money to cover the debt, even if they were to get the new loan. That's where the self implosion is happening.
Tragic. I feel blessed that my first loan was in the sixes for commercial debt.
Yeah.
I almost got one of the fours. I signed it. The person at the bank signed it. It was funding day and they didn't fund. And we were at like, I think it was 4.625 or something, 4.675, something like that. 10-year, there was some interest only period. It was going to be amazing. and then they just didn't fund. They went silent. This was during that period. So I almost got one in the fours, but never did. My first bank loan was in it was mid sixes. And
Dang.
so I think that did, even though I really wanted that money back then, which did everything right, it was probably for the best that I didn't get it because all of my deals were based on 6%, 7%. I got some at 8% and they still worked.
See, the beauty of how you started your business, which is different for me. I was getting I mean, I've done 50 plus loans below 4%, right? So just because I started a few years earlier, the beauty of how you started, you had to figure out how the money made the money, right? Without the interest rate being a factor, right? Because like if you're always operating at 6%, let's just say that's what it is today. You've never used financing in terms of interest rate per se to make a deal, right? Now, I
Mhm.
know I bought tons of deals that make sense at 4%, not necessarily six. If you buy yours at six and they make sense at six, they obviously only make more sense at 4%, right? So I think that's something that it could have been harder for most people to start, but you've trained yourself to be able to operate on a higher interest rate, which means you got to get better deals.
Yeah. And right now I'm borrowing in the high fives. So I just did a refinance at 595. I'm doing a cash out refi right now at 5.8. So the nice thing is on those big loans, and this might be the saving grace for Brandon. If rates tick down at all on $700 million of debt, you save so much money.
Oh yeah. Let's just say the sky does fall. We have the SpaceX IPO coming up Friday, right? That SpaceX IPO could be the uh, the top of the top of the top, if you will, where the whole market implodes, right? Because like in back to the original comment, there is no fundamentals on these businesses outside of the AI ones that are actually they're profitable, and some of the top majority of the companies that their valuations have gone up. For example, could be like GameStop, right? There is no profits there, right? And so I think this is going to be Brandon's canary in the coal mine on the syndicators. Maybe SpaceX is the catalyst that shows everybody that fundamentals are going to rule the world, which they have been from day one.
You see that comment
Yes.
from Brian? Said you were in tech. Did you buy value add or mostly turnkey? Uh,
So
sorry.
on when I was really scaling, Brian, the majority of the properties that I bought out of state, I'll call them turnkey, but not. There's two types of turnkey. There's a turnkey that you actually buy from a provider. They've bought it, they fixed it up. They're a property manager. They sell it to you. You effectively just give them the money in our property. I never did a turnkey like that. Now, most of the stuff that I bought, there was tenants already in there. They're a property manager or the owner was already managing it. I just bought it and then took it over. Later on, I would say, as I started getting into some other coaching and mastermind, I did some more value add. I burr properties, buy, rehab, rent, refinance, and repeat. I did a couple of those projects, 21, 22, 23 kind of time frame. But when I was in tech, I didn't have as much time because I was doing, probably 50, 60 hours a week just on the day job. So I didn't have as much time to do these value adds. As I started shifting and focusing more away from, shrinking my hours down at corporate, knowing that I'm on the way out and increasing the hours on other investment stuff, that's when I started to get into the value add. So like the one that I own in Yakima, sixplex. That was a wraparound seller wraparound mortgage creative deal in Yakima, and then I fixed it up, kicked all the tenants out, put brand new tenants in, refinanced that one out. That one, it wasn't a full burr. I think I still had like 10% left into the deal, but these are kind of the projects I was getting into post as I was shifting into the straight investor world.
Cool. Well, do you have any other things you want to jump into from the video?
The one that I really want to hit on is because Brandon has done a great job of building a personal brand, right? When you hear Beardy Brandon, at least I think in our
Everybody knows. Yeah.
everybody knows, right? Beardy with a Y, right? And he's done everything around that Beardy Brandon persona so that you know him, know, like, and trust him to invest with him. All that can go away. What he built, I mean, gosh, he's been in this for 10 plus years, maybe 15. Um, all that can go away based on how he operates from today forward, right? Now, can he still be positive and have a good brand after he lost the 15 million? There's a lot of people that probably still haven't heard about it, right? If he ends up going and losing a lot more, the odds of his brand being, surviving decrease. So if he goes into this and he does find a way, and he was talking about building a $100 million business to basically be able to sell that to fill the gaps. If he truly does that, his brand will be stronger than ever. If he
Maybe.
doesn't do that, in my opinion, will at a minimum be tarnished, most likely implode, and he'll separate from the Beardy brand and have to create some other new persona.
I guess that's how you do it, right? Wasn't he gonna start selling a program to noobs for $10,000? Wasn't that like part of the agenda?
He already is doing that. So I took quite a few notes. So he's similar to me. He has a ton of different income streams. Obviously, he has more zeros behind his income streams, but
Oh, more zeros than all of us. Yeah.
yeah. So he has royalties on. These are just a handful. Royalties on books, mastermind courses, brands, i.e., the coffee brands. He has podcasts. He has multiple properties he owns by himself. He has the mortgage companies. He has the syndications. He has affiliates, referral programs. He mentioned a lending company. I'm sure there's 10 plus more income streams. So one of them, like you said, he talks about how he really came down to the riches are in the niches. And he said, instead of trying to be Alex Hormozy or Dan, I think it's Dan Martell, which there are the two most prominent business people, instead of him being like all things, everything, real estate, he's niching down very specifically. And he said he's done really well. And the first deal. And he says, all we do in this specific course is we help people buy their first deal. He then talked about, well, if you want to learn how to buy mobile home parks, he's thinking about creating a program just for that. So, yes, education. He's going to continue to do that. I mean, obviously, he had to do a ton of business in the education side to fill that hole if he's really going to step up and try to fill that hole. I don't think 50 million is the number. I think it's a lot bigger than that because like if because the way if I heard it right, there's literal I thought he said just the one property, not the 15 million he's already talking about. There's another property, which is probably why he's living now in Texas, not Hawaii. I thought it in there it's towards the beginning that he says there's like $50 million that if he doesn't figure that out, that it's basically gone.
Well, it's a good thing for everybody, especially like in his situation, him. Like we all have issues and everything's figure outable.
Yeah.
So hopefully he figures it out. It's not about him at this point. It's about all the people who put money in the deal. Like that's the really sad part. But
Yes.
everybody's got issues and he got himself there, so he can probably engineer his way out, which is the positive note.
Oh yeah. And we all have, I'm sure you have some, I have some. Like I'm actually closing on a property today where the last 3 years it was a negative drain on the cash flow, right? So all of the other properties I had, there's two investments that literally wiping that other cash flow out. And one of them I sold out in December. And then the other one is today. So, you know, November of last year, it was almost 12,000 a month negative related to two properties. As of tomorrow, that's gone. So in the last 6 months, these two properties went from negative 12,000 to like zero impact on the cash flow.
Hmm.
So now, could I have just let everything go? Yeah, of course. But I have my own money in there. I have friends' money in there too. I'm not about to lose money for my private money lenders or the hard money, right? Like, could you file bankruptcy and then not pay back the hard money? Of course, but that's not the right thing to do. So today, I'm paying back to private money lenders. They're making their 12% on the money for the entire period, and the hard money company is getting paid back. And then now, like, that negative is not is hitting me every month. So, you know, the month of July will be instead of the first of the month where that money's going out. It's going to be nice not to have that negative drain. So, can you come battle through all these? Yes. You have to find out what your niche is, or you have to find something else that's filling that bucket. For me, it was agent business, it was some other ancillary businesses. Some of it's selling assets to cover the hole. Brandon's going to do the same thing. He's going to take existing businesses, generate more, come up with new businesses or new investments that are going to have to fill the gaps. The question is he going to do it or not?
I got out of my last hard money loan, kind of like you're talking about, a year ago, year and a half ago. I don't miss it.
Right.
Not at all. I don't know that I'll ever do one again.
Yeah.
They're so expensive.
They are super excited and they have a time and a place, man. And for me, the learning curve, what really ultimately did the issue at a couple, one is doing too many things at once. So if I would have just done one versus the two projects, that would have shortened the timeline. Two is not knowing what I didn't know. And then three, the contractors, and four is the permits. These four things all hit me all at the same time. So what should have been done 18 to months, max 24, took me almost 3 years on both projects. So um, just if you put the math together, that's hundreds of thousands of dollars, probably in the tune of $400,000 over 3 years that I have been paying this negative to pay the hard money, the private money lenders off through the project, right? So now one of them, yes, I took a loss on. The other one, I have land. I'm going to do some build to rent there. So like, at least there's a way to get a chunk, half of that money back when I do the build to rent. But the key here is like I learned a ton out of that, and I am paying everybody back. So I feel I can operate, and in terms of my brand, I don't have to worry about it because everyone still won. Um, I'm really interested to see how Brandon, because he was already, probably the top five at least, if not top three most prominent brands out there in the real estate space. He can go from superhero to villain literally in the next couple months if he doesn't find a way to rescue these deals.
We shall see. Alrighty. Well, Justin, anything else you want to chat about today before we drop? I think we're all good.
I'm good. It's good catching up
Well,
again.